Welcome to Technical Analysis. In this module, we are going to look at the technical aspects and trends for currencies. Technical analysis supplies the tools for answering the question, when should I make the trade? History repeats itself in regular, fairly predictable patterns. These patterns generated by price movements are called signals and trends. In this section, we are going to be examining how the technical analyst's goal is to uncover the current market signals by examining past market technical indicators and trends. Experience shows us prices move in trends. Technical analysts believe price fluctuations are not random and unpredictable. Once an up or down trend or sideways range has been established, it will usually continue for a period. To help us with the technical analysis, we have asked Sean Hyman and Evaldo Albuquerque to guide us. Welcome, gentlemen.
Thank you, Bentley. Technical analysis is a vital part of any investor's or trader's tool chest for following movements and trends in the currency market. Technicals are very similar between stocks and currencies. Now, the same basic rules and guidelines apply to both. Good investors and traders rely on price charts, volume charts, and other mathematical representations of market data, also called studies or technical indicators, to find the ideal entry and exit points for a trade. Some studies help identify a trend, while others determine the strength and suitability and sustainability of that trend over time. Others help you to determine the high probability entry and exit points. Technical analysis can add discipline to and minimize emotion in your trading plan. Without technical analysis, it can be hard to screen out fundamental impressions and sentiment and stick with your entry and exit points as planned. While no system is perfect, technical analysis helps you to see your trading plan more objectively and dispassionately, really. Fundamentals help to answer the question of what to trade, and technicals help to answer the question of when to trade it. Technical analysis of price chart movements can improve trading by providing a map that reveals important aspects of what the price has been doing and how it got there. Bar charts are a common type of chart showing price action. Each bar represents a period of time. A period can be as short as 1 minute, or really can be as long as several years. Over time, bar charts show distinct price patterns. Instead of a simple bar chart, candlestick charts show the high, low, opening, and closing price for the period of time in the chart that the chart represents. Candlestick patterns provide greater visual detail as they develop. Then you've got line charts. Line charts simply track the closing prices of the currency pairs for a selected period. They are very useful in comparing one currency pair to another.
So, Sean, can you tell us a little more about technical indicators?
Yeah. Price charts help traders identify tradable market trends, while technical indicators help them judge a trend's strength and sustainability. If an indicator suggests a reversal or a change in direction, confirm the shift before you take action, it might be worth waiting for another period to confirm the same indicator signal or checking out another indicator to compare.
Okay, well, so this to me sounds like it requires a lot of patience and I imagine practice.
Patience is an important part of technical analysis, and to help you read the signals accurately and respond accordingly, really.
Okay. Evaldo, what is the best technical indicator that we should monitor?
Well, there's no single technical indicator that can be exclusively relied on, as the currency market is simply too complex. This is because technical indicators can never fully capture all of the variables that influence price movement. Trend indicators smooth price data out so that a persistent up, down, or sideways trend can easily be seen. Some examples are moving averages and trend lines. Trend lines provide a projection of support and resistance that links past behavior into the future. There are inner and outer trend lines that are important indicators of a shift in sentiment that should be tracked as well.
We hear the term volatility all the time. What does this refer to? Maybe, Sean, you might want to take a shot at that?
Yeah, volatility is how much the pair is going up or down, or the magnitude, rather.
So what else would demonstrate volatility?
Well, cycle indicators indicate repeating market patterns from recurrent events, such as seasons or elections. Cycle indicators determine the timing of a particular market pattern.
Could you provide me like an example of something like that?
Yes. wave analysis. Now, support and resistance describes the price levels where markets repeatedly rise or fall and then break out of their pattern or resume the previous trend. This phenomenon is attributed to basic supply and demand. Momentum indicators determine the strength or weakness of a trend as it progresses over time. Momentum is highest when a trend starts and lowest when a trend changes. When price and momentum diverge, it suggests weakness. So if price extremes occur with weak momentum, it signals an end of movement in that direction.
Okay.
If momentum is trending strongly and prices are flat, it signals potential change in the price direction.
One of the most widely used indicators is moving averages. Can you describe what moving averages are? Evaldo, maybe you can help me here.
Sure. Moving averages help traders verify existing trends, emerging trends, and view overextended trends about to reverse. As the name suggests, these are lines overlaid on a chart that average out short-term price fluctuations so that you can see the long-term price trend. A simple moving average weights each price point over the specified period equally. The trader defines whether the high, low, or close price is used, and the price points are added together and averaged, forming a line. A weighted moving average gives more emphasis to the latest data. This smooths out a price curve while making the average more responsive to recent price changes. An exponential moving average weights more recent price data in a different way by multiplying a percentage of the most recent price by the previous period's average price. It can take a while to find the best combination of moving average and period length for your currency pair. The right combo will make the trend you're looking for clearly visible as it develops. Finding that optimal fit is called curve fitting. Usually traders start by comparing a few time frames for their moving average over a historical chart. Then you can compare how well and how early each time frame signaled changes in the price data as they developed, and adjust accordingly.
When you've found a moving average that works well for your currency pair, you can consider this as a line of support for long positions or resistance for short positions. If prices cross this line, it often signals a currency is reversing course. Am I correct?
Yes. In fact, here's an example. Longer-term moving averages define a trend, but shorter-term moving averages can signal its shift faster. That's why many traders watch moving averages with different time frames at once. If a short-term moving average crosses your longer-term moving average, it can signal your trend is ending, and that's a good time to pare back your position.
Okay, we're getting quite technical now, but that is what the section is all about. So, Sean, can you kind of provide us with some information on stochastic studies and oscillators?
Sure. Yeah, they help to monitor a trend's sustainability and signal reversals in prices. Stochastics come in two types, %K and %D, measured on a scale from 0 to 100. And %K is the fast, more sensitive indicator, while %D is really the slow and takes more time to turn. Stochastic studies aren't useful in choppy sideways markets, as %K and %D lines might cross too frequently to signal anything. But like stochastics, the relative strength index, or RSI, measures momentum of price movements on a scale of 0 to 100 as well. Always confirm RSI signals with other indicators. RSI can remain at lofty or sunken levels for a long period of time without prices reversing, of course. All this means is that a market is quite strong or quite weak and likely to stay that way for a while. So adjust your RSI to the right time frame for you. A short-term RSI will be very sensitive and give out many signals, not all of them sustainable. A longer-term RSI will be less choppy, so try to match your RSI time frame to your own trading style.
And please remember, as all of us have put acronyms and things in your glossaries, so gentlemen have helped me write this. Let's delve a little deeper. Could you tell us about Bollinger Bands?
Sure. Yeah, basically Bollinger Bands are volatility curves used to identify extreme highs or lows in price. Bollinger Bands establish bands around a currency's moving average using a set of numbers of standard deviations around the moving average. Then you've got MACD, which is really pronounced like MAC/D. So MACD plots the difference between 26-day moving average and the 12-day exponential moving average. A 9-day moving average serves as the trigger line for that MACD. When the MACD crosses below the trigger, it is a bearish signal. When the MACD crosses above the trigger, it's a bullish signal. So if MACD turns positive and makes higher lows while prices are still tanking, this could be a strong buy signal. And conversely, if MACD, makes lower highs while prices are making new highs, this could be a strong bearish divergence and a sell signal.
Okay. Can you tell me about Fibonacci retracement levels and what do they do for us?
Yeah, they are a sequence of numbers discovered by the noted mathematician Leonardo da Pisa in the 12th century. These numbers describe cycles found throughout nature. Technical analysts use them to find pullbacks in the currency market. After a significant price move up or down, price often retrace most or all of their original move. As prices retrace, support and resistance levels often occur at or near the Fibonacci retracement levels. For currencies, that means retracements usually happen at 23.6%, 38.2%, 50%, or 61.8% of the previous move.
So how can we cash in on a short-term currency trend?
Yeah, most of the time markets don't show a clear trend. They bounce back and forth between support and resistance levels, and the sideways movement is called a trading range. So we need a strategy to identify entry points on short-term trends. The strategy uses two charts with different time periods, like 10-minute and hourly, for instance, along with two technical indicators, maybe like a 200 bar type of moving average and a 14 bar slower period moving average or stochastic study as well. Compare the moving averages on both charts. A trend may be developing when the price is consistently above or below the moving averages on both charts. Also draw a classical trend line on both the 10-minute and 1-hour charts in this example to identify the trend direction. Once you've identified a trend, look for the following two conditions at the same time on the 10-minute chart. The price is no more than 20 pips above to buy or 20 pips below to sell the moving average.
Let me explain PIP for a moment. A PIP is the smallest increment in which a foreign currency can trade with respect to identifying breaks of technical levels.
Yeah, in the fast stochastics, the %K crosses above the slow stochastic %D below 20 to buy, or crosses below the slow stochastic above 80 to sell.
Okay. You've probably heard the expression, the trend is your friend. Is this always the case?
Well, if your trend takes a sudden counter move and your trailing stop activates at a loss, it's natural to ask yourself, how can you be sure the next trend will be friendlier? Using technical indicators in combination can help to ensure a potential trend has staying power. This is a good habit for all kinds of technical trading, but especially in the currency market. Currencies tend to move in trends naturally due to long-term macroeconomic factors and short-term international capital flows. From a trader's perspective, a trend is a predictable price response at levels of support or resistance that change over time. And trend lines mark these levels with support acting as the floor and resistance acting as the ceiling. When prices break through either of these levels, this signal is a trend for that movement to continue. But remember, a break is a concept and not a precise line. So if you think there's a break on a chart, go to a lower time frame to confirm that break. It's easy to draw a perfect trend line on historical charts, but harder to be right when the trend is still developing. Still, trend lines still help us focus our attention on finding support and resistance levels, which is the first step in identifying a new trend.
Okay, so how do I do that?
We'll start by drawing trend lines over longer time frames. That's the easiest way to get started. Daily, weekly charts, things of that sort, and then carry them forward into shorter time frames like hourly or 4-hour type time frames. This practice basically, this way you will highlight the most important support and resistance levels first and not lose the major trend development by chasing the short-term minor trend. Then you got things like the directional movement indicator, or DMI. This minimizes the guesswork really in spotting trends and helps confirm trend line analysis as well.
Okay. The methods we have just discussed can be used for short-term decision making, even in markets that are trading sideways or a trendless market. However, if you're trading short-term, don't ignore the big picture entirely. There's no point in trying to ride a short-term trend that is counter to the long-term trend. Much has been said about the suitability of technical analysis for trading in the currency markets. While this is undoubtedly true, it can leave traders, particularly those new to currency markets, with the impression that all technical tools are equally applicable in all situations. Perhaps most dangerous from the standpoint of profitability, it can also lure traders into searching for the proverbial silver bullet, that magical technical tool or study that works for all pairs all the time.
Yeah, traders are more likely to experience improved results if they recognize the differences between trends and ranges and employ those different technical strategies to them.
Yeah, and one of the great things about Forex is the presence of many trading styles. Each style offers opportunities to find high probability trades and fit within a personal preference of the trader. So can you tell us some of the things that different trading styles and people do?
Yeah, if you're looking for quick moves, you can quickly adapt to like scalping type strategies and tactics. These trades capture pips in very quickly, perhaps within minutes even. They fit with traders wanting to trade before they go to work, kind of a thing. Many currency traders put on trades that have moderate size intraday durations that allow the currency pairs to move throughout a broader range, and these traders tend to spend more time watching the charts and tend to favor managing the trade from its onset to its conclusion. Larger pip moves are possible, approaching 30 pips or more, what have you, but the risk is really a little bit larger.
Okay.
Then you've got like set and forget type trade, which involved multiple day trades, hoping for larger profit objectives of 100 pips or more. These trades cannot be watched continuously and require appropriate leverage and risk management, of course.
I would imagine, yeah.
Yeah. Forex trading can also include the goal of trading for income by using carry trade strategies or even options. But a carry trade is a strategy where an investor sells a currency with a relatively low interest rate and buys a different currency yielding with a higher interest rate. And this is a dominant strategy for large hedge funds and institutions, but carry trades are also possible for the average retail trader as well.
Someone new to trading currency should explore many of these styles and strategies by creating trading setups that use a combination of technical indicators and chart patterns and pinpoint conditions for trade. But there's no single style of trading technical indicator methodology that will be sufficient. Am I correct?
Yes, successful currency trading is a combination of fundamental knowledge, technical tactics, and experience in pattern recognition.
So can we look at some setups that have worked well for traders?
Yes, let's start with the bounce trader. The bounce trader waits for price to enter into sideways range. The price could be coming from a downtrend or an uptrend, but there are likely to be pauses along the way. The bounce trader will select a direction to trade by looking at the larger picture and using fundamental analysis as well. The key price action the trader is looking for is to wait for the failure of the price to penetrate either resistance or support. The price could in fact close above resistance or support and then proceed to fall back. If all of the indicators are lined up, this provides a high confidence that the setup for the trade is reasonable.
And so what other types of traders, what do we have?
Well, you've got the scalper. He has the goal of quick trade for a small but leveraged profit.
And we spoke about before. Yeah.
Right. Yeah. This type of trader prefers to trade frequently for small moves and trades in very limited time frame, from like 10-minute candles to 1-minute candle charts.
Wow.
Yeah, it's something. And the intraday trader needs more patience and is looking for a bigger move than the scalper, who is happy with even less than 10 pips. So larger time frame intervals are required, such as the 30-minute or even 4-hour charts. But what you're looking for here is a wider range of maybe 60 pips or more to locate a trade, preferably near support or resistance. And this type of trade requires a sniper type attitude, waiting for just the right moment. A lot of patience, really. Yeah. And then the trend trader isn't just looking for reversals, but wants to move with the crowd, with the trend. When the pattern confirms a trend continuation, you then go for the trade. Often you will need a very few indicators really to recognize a trend pattern. When it's intact. The key here will be to avoid being too late and then chasing the trade. But by using multiple time frame charts, really this problem can be solved and minimized. The set and forget type trader is playing fundamental direction and is seeking very large moves of 100 to 300 pips or so. And this type of person doesn't want to sit and watch the screen, but plays for the longer moves and all those forces behind the market. Then you've got like a news trader. A news trader focuses on trading the economic news releases, the market patterns related to the news. Trade display distinct patterns. And first is like a sideways pattern that exists there. There's always a hesitation about the outcome, and so you've got that type of pattern. And then you've got a surprise result that causes a sharp move in one direction or the other. Through the form supportive resistance, support and resistance levels. And then after the initial impulse, it will try to sell off and retrace. And it may succeed in returning to the initial sideways range, or simply to the point of retracement, then pause and then resume the move in the direction of the break. So these phases are a part of every economic news release. Responses to it by the market. News trading can be done in several ways, really. You've got pre-news anticipatory type trade involving putting on a trade before the announcement. The
expectations, right?
Yeah. If the trader's correct, they can be a big win.
Right.
But it requires excellent predictive ability, and that's really something that few people have.
Right.
And when you're on the wrong side, stops don't help much either, because the huge movement through the stop.
Well, it really depends where your stop is, but I see what you're saying.
Yeah. So next is to trade at the break here. So the trader puts on the trade right as the breakout is happening and joins the move, and it requires a very good platform and technical skills on how to exit when there's such a great momentum. There's a risk of a whipsaw, of course. It's not for the timid or faint of heart at all. In a hedge trade, the trader buys and sells the currency at the same time and get out of the loser immediately and rides the winner. On big moves, it's a good way to gather pips. On smaller moves, it may cause really a loss on both sides.
Okay. There's a lot to absorb in this module, and just listening to it once is not going to make you a successful technical analyst. Successful trading takes practice and experience. But once you understand how to apply it to currencies, your trades will be more successful. We have given you some examples in your companion workbook to work through as you're listening to this program, or in the future when you want to sit down and practice technical charts and trading styles. Successful trading means the trader has detected a high probability repeated pattern. Some patterns appear across currency pairs, while others are more commonly found emerging in one pair. Over time, the trader gains a more thorough understanding of the various market traits for currencies and will find that certain technical tools are better suited to some currencies or some trends than others. A currency-specific approach to applying technical analysis is more likely to produce successful results than one-size-fits-all application across everything. So let's summarize all of this together. What are the 3 technical triggers that we need to learn first? Sean?
Yeah, I would say first, you want to really establish the trend, and I think the easiest way to do that really is to start with those moving averages. So start with some moving average, maybe a 50-day moving average or a 200-day moving average on the daily charts. That's number one. You find the trend direction, and then number 2 is to use an indicator to help you form an entry into that trend. So if your trend is up, you're looking for buy signals. If your trend or moving average was down, you'd be looking for sell or sell short signals. And so you could do that easily by using like that slow stochastics indicator that we talked about.
Sure.
Some common settings there like 1433 or something like that. But you want to use that indicator is a very good one. Also another one for trend analysis. Really the third one that helps confirm trends and bigger swings and turning points really is your MACD. It can be very helpful for people who want to stay in trades a while or want to further confirm the trend or their entry point or exit point. It can be very helpful as well.
What's the easiest way to start technical trading and tracking? Evaldo?
The easiest way is to open a practice account, a paper money account. Most brokers offer all the most important technical tools. So you'll be able to open an account and play around with the several technical indicators that are available. That way you'll be able to learn without the risk of losing money.
Okay, great. Yes, we talked a bit about that earlier. So, where would I go for the best charts and for the best data? Sean?
Yeah, You know, we live in a great day and age where you know, you can actually get real-time charts and quotes with all these technical indicators that we name for free. And so you can really just look to your broker. The broker you sign up with will have, you know, contain within their trading platform a free charting package that literally will have every one of these indicators that we've discussed with real-time data feeds going through them, real-time charting, all for free. So really, that's probably your best choice of all.
That's great. And we've included in the companion workbook some different possible free charting systems and brokers that you might want to look up, or they may be on your screen as we discuss it. Gentlemen, you gave us a lot of information in this module. To both of you, what is the best takeaway you can give our viewers about technical analysis? Sean, could you start?
Yeah, I would say keep it simple. I think a lot of times people will put like 10 or 15 different indicators on their chart, and it really clutters and it really confuses more than anything. I call it, analysis paralysis is what the trader can get. And so keep it simple. An indicator or two or three on the chart, maybe one that tells you the trend, and one or two that gives you confirming entry points, and just keep it at that.
Okay.
Keeping those signals with the trend. That's what I would say.
That's very good advice. I actually, the first time I started doing that, I started piling one thing on top of the other, and before I knew it, I couldn't even read it. So one or two things, follow a trend, something in that space. Evaldo, what do you think of that particular, and what can you share with us?
I would say start with the most basic technical indicators, such as the moving averages and trend lines. You can also use paper money accounts to look at historical data, historical charts, and you can look back and see what works best for you.
Okay, great. Well, thank you, gentlemen, for all of your insights. This was incredibly valuable, and we really appreciate you spending the time here with us to review this, and the time that you've helped us in developing the companion workbook and putting together some of the exercises for our students of this program. There is a lot to absorb in this module, and technical analysis is an area that you need to know and master to be able to follow trends. My suggestion is that you open a Forex mock trading account that has charting tools and practice follow charting trends of the major currencies, just as our experts have suggested. It can actually be fun and a rewarding experience, as I found when I first started doing it. Thank you for being here with us, and this concludes the technical analysis module. Remember, there is a short exercise in the companion workbook for you to practice, plus the charts and other exercises to get a little more practice in doing this. We look forward to working with you in the future on other modules. Goodbye and great success.